So with that, I'm going to turn it over to Matt, and thank you again for joining us.
Thanks, Matt. I appreciate it. We're going to walk through our first quarter financial markets commentary, which is available on our website today. The first quarter was really a bit of a surprising quarter. It seemed like as soon as the year turned from 2018 until 2019, the market flipped from its ugly fourth quarter declines to the exuberant first quarter gains. And the key driver of that was the Federal Reserve and central banks across the globe that really moved from being more from a tightening stance and tightening economic conditions to being more accommodative in their posturing. This led risk assets across the boards, whether it was in equities or commodities or even within the fixed income markets, to have extremely strong gains. And you may hear me say this a couple of times in the discussion today, but in a lot of asset classes, we saw years worth of gains happen in just the first quarter alone. What I think we learned as we kind of look back on the first quarter, really that central banks are going to be accommodative when we go through these experiences of stress in the economy. And when we saw the markets kind of fall in the fourth quarter, and particularly hard in December, the Fed kind of changed its tune and decided it was going to provide a backstop and provide support to the markets. This is often kind of referred to as the Fed put, in that when markets do decline, the Fed will shift its stance and become more accommodative, and it was clearly the case in the first quarter. As we look at the returns in the quarter, just to kind of highlight the benchmark that everybody typically goes after is the S&P 500, which was up 13.65% in the quarter, a very strong quarter for the S&P. And we have a number of common indexes here listed on the page, and I'll get into many of these in greater details later in the presentation. But I think the key highlight that I take away from this page is as you look in the quarter-to-date return column, in the first quarter, all of those numbers are green or all of them were positive. So again, it goes back to regardless of the asset class you were in, on an absolute basis, you had pretty good returns in the first quarter. When we look at the global economy, things are going pretty good. We are 10 years into this economic cycle and things keep kind of chugging along. I kind of think of it more as a Goldilocks economy. Things aren't too hot and they're not too cold right now. Although as we're getting 10 years in, we are starting to see kind of the rate of growth decelerate. That is one of the things we've been noticing really over the past year or so. And so when you look at the global economy right now, the forecasts are for the global economy to grow about 3.3% in 2019, pretty strong number, although that is down from 3.6%, which is the rate we experienced in 2018. So again, that rate of deceleration at the margin. A key factor that's gone on in the markets, in the economy, the global economy over the past 6 months or so is really the impact of trade. And the surprising thing to us is the synchrony within that impact. And so if you look at the bottom two charts, which really looks at export volume growth, you really see export volume growth almost falling off of a cliff, if you will, in the back half of 2018 and into 2019. And a key driver of that, obviously, is the trade negotiations that are going on between the U.S. and China. We're calling that the tariff tantrums. And while those are really just between the U.S. and China, they do have broader impacts to other economies around the globe. And to maybe put this in a little bit of perspective, if you're a company's CEO or CFO and you source a lot of your goods and your raw materials for your inventory out of China, so maybe you're buying Chinese steel. Well, in September, there was a 10% tariff that went on $200 billion worth of exports coming out of China. So if that was Chinese steel and you bought Chinese steel, you're now paying 10% more for that raw material. So you're a little conscious of the amount of inventory you want to keep in that steel, considering you're paying a 10% tariff. However, at that time, in the early fall of last year, the rhetoric was that those tariffs in December were going to go to 25%. So in the back of your mind, you wanted to have enough steel where if those tariffs went to 25%, you weren't immediately paying more for that steel. But at the same time, you were hoping those trade issues would go away and you wouldn't have to pay that tariff over time. And so what we really saw coming out of that is a lot of companies really ran down their inventories. Any excess inventories they had, they worked down. You kind of saw that as a destocking. And that's a big driver of what led to a lot of the exports and going down, as we just saw inventories come down significantly. It does seem like we've hit a point where that started to change and you can only draw down your inventories to a certain part and you need to restock them. and I'm getting a little ahead of myself, but one of the things we actually saw last week in that first quarter GDP print, it was better than expected, largely because we saw some inventory restocking as companies got to the point where they said, I just need to restock my inventory, especially as we're getting into the summer months here. And so it is important as we look at what's happened in the global economy to take a pause and kind of be aware of the impact that the tariffs have had, not just in the US, but elsewhere, because China is a big buyer of German exports. And so this tariff tantrums aren't just between the US and China, but they have broader implications. If we look at kind of the global economy across regions, if we really look at more the developed regions, so in North America, Japan, and the Eurozone, growth is there, but it's fairly tepid. You know, if you look in North America and take out the US, growth is kind of between 1% and 2%. In Japan, kind of expectations are for sub 1% growth. It's growing, but not a whole lot. And in the Eurozone, growth right now is expected to be about 1%. So fairly tepid growth. China, well, there's a lot of news headlines about China's economic growth slowing, and it is. It's still expected to grow at about a 6% rate here in 2019. That is less than the 6.8% it was growing in the first half of 2018, but for most other countries in the world, 6% growth is quite attractive. Within the US, it's kind of that the growth just continues to chug along. Right now, we're expecting 2.6% growth in GDP here in 2019. We go back to that first quarter GDP report that came out on Friday, it was at 3.2%, so stronger than the 2.6% expectation for the year. And that partial of that, again, is due to the expectation, or due to some of the restocking that we saw in inventories, and that's likely to kind of pull from the second and third quarter of this year. And so you might start to see some more headlines coming out of how second and third quarter GDP estimates may be revised down because some of that growth was pulled into the first quarter. Consumer confidence is something that we watch just for the stability of kind of the economy and the ability to see if it has continued legs to it. And you saw great growth in consumer confidence last year. The tax law changes had a big impact on that. As we've gotten into 2019, the growth in the consumer confidence levels has started to level off, although they remain at pretty high levels. And one of the encouraging things we're seeing is that among lower income households, we're still seeing very strong consumer confidence levels, which is a good thing from an income equality front. On that point, the other piece is job growth and gains. We know the unemployment rate is low, but wage gains right now are looking to be at 3% plus on the year, which is a strong number. On the US side of things, a key event that happened this quarter was the yield curve inversion, or at least talk about the yield curve inversion. And the yield curve inversion, what that is when we see long-term interest rates, which are typically looked at as the 10-year Treasury rate, are lower than short-term interest rates, that's the indication of a yield curve inversion. There's kind of two definitions of that inversion. The one yield curve inversion that did happen was that between the 3-month Treasury bill and the 10-year Treasury yield. That occurred in March, where the 3-month Treasury yield for a couple of days was actually higher than the 10-year Treasury yield. That has since reversed to some degree. We tend to look at yield curve inversion along the range of the 2-year Treasury and the 10-year Treasury. And the reason we do that is the Federal Reserve is highly influential on short-term interest rates up to that 3-month Treasury bill. When you get out to 2 years, that's more market dependent, and that's an indicator of whether the market's looking at negative signs for the economy. And that did not happen. This chart that we have on this page shows the spread between 10-year Treasuries and 2-year Treasuries. And so you can look back to towards the end of 2013, that difference in rate was almost 2.5 percentage points, meaning the 10-year Treasury was yielding 2.5 percentage points more than the 2-year Treasury. And today that number is very close to zero, although it's been kind of leveling off of late. The impact of it, and the reason this is important, is the yield curve inversion has historically been an indicator that a recession may be on the horizon. And so this chart that we have here shows the spread between the 2-year Treasuries and 10-year Treasuries. And when that spread is negative, you'll see that in the orange line, that's when the line is below zero. We have those tall vertical gray bars. Those are periods of where we've had an economic recession. So you can see when that orange line goes below zero, shortly thereafter, we've tended to see recessions. Now, it's important to point out it tends to be a leading indicator of a recession. So it's anywhere from 6 to 18 months is typically after we've seen the yield curve inversion is when we've seen a recession. So as of now, we've not seen the yield curve on a 2 and 10 year basis invert, but it has been pretty close. It's also important to note a yield curve inversion doesn't cause a recession. It's really an indicator that economic conditions are softening to a point where some are thinking that it's likely the Fed's going to have to lower rates, and that may be a sign that a recession is on the way. So this is something that we are taking note of and keeping our eyes on, and do think it's a noteworthy point that occurred during the quarter. One of the key things that happened, and we talked about this in the beginning, is really a pivot for the Federal Reserve and central banks across the globe on moving from going towards more of a quantitative tightening standpoint to quantitative easing. And if you think we'll look back to the global financial crisis, we did have a period where the Fed did quantitative easing. So their balance sheet had been about $800 billion worth of securities. And to pump liquidity into the economy, they bought treasury bonds and mortgage-backed securities, and their balance sheet grew to $4.5 trillion. A couple of years ago, the Fed decided that they were going to start to exit those positions. So as they matured, they were no longer going to reinvest and buy more. And so that had the impact of their balance sheet starting to shrinking. That is what we refer to as quantitative tightening. And their balance sheet today is just under $4 trillion. So it's moved down about $500 billion. A year ago, the expectation was the Fed might continue to tighten until their balance sheet got as low as $2.5 trillion. And this quarter, the Fed came out and said, you know, we're actually going to pause in October. And at that point, their balance sheet will be a little north of $3.5 trillion. So a lot sooner than many had expected. And by them not letting those bonds mature and essentially taking that liquidity out of the system, they're becoming more accommodative by switching in their stance here. In addition, other central banks outside of the US have put in various forms of liquidity to also support their economies. And so we've really had this significant pivot from central banks tightening to now providing some level of quantitative easing, although at this point at a fairly muted pace. What we've noticed in the past is when we've had these periods of quantitative easing, they've been very good for the market, and the market's done well during those periods, and we call that out here on this slide. This slide kind of shows, and it's an interesting slide to show kind of what the expectation had been on how central banks' balance sheets would slowly be declining and taking liquidity out of the system. This is obviously not the case now, as central banks have kind of shifted some of their focus. And to be quite frank, we were a little surprised at how quick central banks were kind of cowed into changing their stance and becoming more accommodative in a very short period of time. If we go back to early in the fall, we were expecting, the market was expecting 2 to 3 interest rate increases this year. Now the expectation is, if anything, the Fed would be cutting interest rates. So a very quick pivot in terms of expectations around central banks and what they may be doing going forward. This next slide looks at interest rates, because interest rates have been a story over the last couple of years. They have been going up until this last quarter. And if you look at the chart in the top left, which is the 2-year Treasury yield, you can kind of see we've seen this nice increase in interest rates. However, when you look at the chart in the top right corner, it puts it into perspective of, while we've had this rise in short-term interest rates, when you look at it over the last 40-year period, we still are at quite low levels relative to history. The charts at the bottom show the similar situation, but for 30-year Treasury yields, which even today are still fairly near their all-time lows. As this relates to fixed income markets had a very strong quarter. The Barclays U.S. Aggregate Index, kind of the bellwether of fixed income markets, was up 2.94% in the quarter, which is pretty close to what you'd expect out of a year's worth of returns in the fixed income markets. Within fixed income, the riskier the asset, almost the better return. Corporate bonds did better than treasury bonds. Within corporate bonds, high yield bonds did particularly well, up 7.25%. When you look at maturities, longer maturities did better than shorter maturities. Longer maturities tend to be more sensitive to interest rates. So when we saw interest rates go down this quarter, that was particularly good for longer term bonds. And so those bonds did quite well in the quarter. In the equity market, We had very strong markets, as we talked about earlier. So the S&P 500 being up almost 13.7%, the NASDAQ up almost 17% on the quarter. What we saw is the U.S. stocks did a little bit better than international stocks. International stocks were up about 10% on the quarter. Within market cap ranges, smaller cap stocks, which tend to be viewed as more riskier, did better than large cap stocks. From a style perspective, growth stocks did better than value stocks. Another thing to kind of point out, and something we've been seeing, is when you look at kind of earnings expectations for companies, those estimates are set by Wall Street analysts. And what we tend to see is about a quarter before those earnings start to get reported, you start to see those estimates kind of getting revised down. So instead of the company expected to earn 50 cents, the analysts might start to think they're going to earn 49 or 48 cents. And what we've started to see is the level of estimate revisions is starting to get higher and more on the to the negative side. So we're seeing more negative estimate revisions going into this first quarter, which is a sign that maybe expectations are a little ahead of themselves for company earnings as it relates to 2019. Real assets, and by real assets we mean kind of things you can touch and see on a daily basis. So oil and real estate and commodities had an exceptionally strong first quarter. Oil was up 33%. Real estate was up 16%. That's almost more than a year's worth of returns for real estate. Precious metals like gold and silver were up 8%. The dollar was up 1%. Just very strong returns across the board within real assets. In alternatives, and particularly hedge funds, we saw a bit of mixed results. Equity hedge funds did quite well. In fact, the average equity hedge fund was up nearly 6% in the first quarter. Macro-driven strategies, which are those that try to look across countries, were struggled a bit and were actually slightly negative on the quarter. As we look out to emerging markets, we continue to see kind of steady economic activity within these markets. So India still looking at 7% plus GDP growth in 2019 and even in 2020. Other smaller countries continue to see kind of stable growth rates. So that kind of gives a picture and a flavor of what we're looking at and seeing both in the global economy as well as markets in the first quarter. I think as we kind of look at, in summary, as we kind of look back at the quarter and what we saw, it really was a quarter that was highlighted by the shift away from quantitative tightening to quantitative easing. And this is likely to probably elongate the market economic cycle. We're actually now at a point where the economy continues to grow, the U.S. economy continues to grow into July, which at this point it looks like it will. We're actually going to mark the longest economic expansion in U.S. history. And as we get to that, it looks like the quantitative easing that we're starting to see again is going to help elongate that cycle. However, as we look at this, any additional gains from this point in the year are likely to come, are likely to be borrowed from the future, and so we are conscious of that. And so, for what this means to investors, is you may want to think about rebalancing portfolios. Some of our clients did go through a rebalancing of their portfolio in the first quarter. And it's a good time to really test your risk tolerance. And is that asset allocation truly in line with your risk tolerance? If we go through another period like we saw in the fourth quarter, which we may or may not, but it's a good test to really see is your asset allocation in line with what your risk tolerance truly is. So that's kind of our update on what we saw in the first quarter. Matt, I'll hand it back to you.
Thank you, Matt. So we have a few questions that's come in. So the first question is, with how well domestic is doing in the first quarter, do you see a shift going into international for the rest of the year?
It's a good question, and clearly the U.S. has done better than international markets. The difference being the U.S. economy and just corporate earnings in general seem to be much stronger in the U.S. And the Europe in particular has been pretty lackluster, and their growth hasn't been great. Their stocks, quite frankly, are trading cheaper if you look at it on most valuation levels. But there's really not a catalyst, for a lot of excitement in European markets right now. It's a lot of overhang going on. If we start to get some resolution to the tariff situation between the U.S. and China, that'll also impact Europe and their trade routes. And Brexit obviously is also an overhang, not just on the UK, but on the Euro bloc in general. And so at this point in time, we think it's more likely that we'll probably continue to see strong U.S. returns until some of those items really get ironed out, and then the associated impacts with that kind of get determined.
So continuing a little bit on the rest of the year, how do you think the first quarter sets up for the rest of the year in terms of interest rate and GDP growth?
Yeah, I think the first quarter on the GDP side of things, the first quarter was a bit of, robbing Peter to pay Paul. The first quarter was stronger than expected. Some of that was really taking economic activity from this that was likely to happen in the second and third quarter and moved it into the first quarter. So I don't think we'd be surprised to see lower than expected, at least what the expectation is now, GDP numbers in the second quarter and possibly in the third quarter. As that relates to interest rates, it's kind of interesting because we're going to see the Fed's going to make their announcement tomorrow on what they're going to do with interest rates, and it'll likely be probably no action, probably a pretty tame announcement. But it was a mere 6 weeks ago that the Fed made their announcement on more softer policy stance and then moving away from the quantitative tightening. And the yield curve would, inverted on the 3-month to 10-year level and came close on a 2 and 10-year basis. And since then, the yield curve looks almost identical to what it looked like prior to that meeting. And so it wouldn't surprise us, as I think people realize that the bottom wasn't falling out of the U.S. economy, that we may continue to see interest rates tick higher, particularly on the long end of the curve. It does seem like the Fed's probably out of the interest rate game, at least for the intermediate term period. If they did raise rates at all this year, it would likely be in the fourth quarter. So I think if anything, we see more interest rate movements in the belly of the curve, so kind of around the 5-year mark, and in the long end of the long end of the yield curve.
Short question, just about technology earnings so far in the first quarter.
They've been mixed, but pretty good. I think the trade side of things is probably having a little bit of an impact on it. But, thus far we've kind of seen some, Google's results last night obviously weren't as well received, but thus far we're kind of seeing, I guess, kind of a mixed bag in technology. Semiconductors in particular do look like they're going to be soft. They've been soft for the past year, and right now it's more of the market's anticipation of, is it a quarter or two from now that semiconductors swim back, or is this going to be a softer cycle than maybe some had, or softer downturn than some had anticipated?
And then I believe last question is, do you think a trade deal is on the horizon?
I'm not sure I have any insight there than other people have. I've felt like in March it was close, in April it was close. Feels like it's even closer in May. It does seem like it's in everyone's best interest to have a trade deal done. So I think I'd be surprised if it didn't get done. But I think this administration has clearly shown that it's willing to do some unexpected things when it feels it's necessary. And so, well, I think it might get done. I'd want to hedge that call too.
All right, I think that's all the questions that we have. Want to thank Matt and thank everyone for joining us. We hope to see you again at our next webinar.